CLS Market Review for the week of July 15th, 2013. I'm Chelsea Hartness, in for Matt Harwell. Both the S&P 500 and the Dow Jones Industrial Average ushered in fresh new highs last week. Thanks to Chairman Bernanke's reassuring words regarding continued stimulative policy, the Dow rose 2.17% on the week, while the S&P gained 2.96%. We also saw international markets reverse course, with the broad-based international index also up around 3%. The 10-year U.S. Treasury note rallied, dropping the yield to 2.60%. Here now with a special look at small-cap stocks all the way from Greenwich, Connecticut, is CLS Portfolio Manager Matt Santini. Matt.
When you contemplate portfolio risk mitigation, small-cap stocks are not usually a part of the conversation. In fact, small-cap stocks have inherently higher beta and are oftentimes used as cheap equity leverage. With this higher beta, investors can also expect more volatility. Over the long run, small-cap stocks can reward investors willing to increase their risk profile. The Russell 2000 ETF, IWM, carries a beta of roughly 10% more than the S&P 500 ETF, SPY. Since CLS prides itself on diversification, it would be prudent to analyze international small-cap exposure, specifically income-generating small caps. In this scenario, investors will be intrigued at a dynamically different phenomenon. Let us consider the broad-based FTSE ETF, VJK. The beta in this case is roughly 20% higher than that of the European small-cap dividend ETF, DFE. Although the risk score is lower for European small-cap ETFs, the risk-adjusted and absolute returns have been greater for the small caps. As an added bonus, the small-cap ETF recently has had a higher yield than the large-cap index. When we analyze the small-cap segment within emerging markets, a similar pattern unfolds. Here, too, we see roughly 20% higher beta for the large-cap emerging market ETF, EEM. The emerging small-cap dividend ETF, DGS, has offered higher risk-adjusted and absolute returns when compared to its large-cap counterpart. This particular ETF offers a very robust yield of over 400 basis points, roughly 100% more than EEM. To get a better understanding of the macro drivers that facilitate these returns, it is important to analyze the composition of the holdings. International and emerging market broad-based indexes are comprised of large companies that derive a lot of state-directed revenue. Investors have tended to discount socialized economies in times of uncertainty. Take, for instance, Russia and China. These two regions, although GDP powerhouses, can see volatility in the mega-cap space as central banks manipulate currencies and interest rates. Volatility also results from government intervention in the form of monopolistic behavior, suppressed consumers, and excessive tariffs. The international and emerging small-cap space, although not immune from state-directed companies, garners exposure from more capitalistic and free market companies, and oftentimes economies on the whole. In this week's podcast, I will be joined by CLS analyst Grant Engelbart for a discussion about the aforementioned ETFs. Grant works with me on the Advisor One Select Appreciation Fund, and he's the resident ETF guru.
Thank you, Matt. For those of you not already subscribed to our podcast, simply search for CLS Investments on any iTunes-enabled device. Also, be sure to look for our quarterly market review debuting this Thursday right here at clsinvest.com. That concludes our update for the third week of July. We hope to see you back next Tuesday. Have a great week.